In this video, I'm going to show you exactly why your 15-year mortgage is actually costing you money in the long term. I know a lot of people get really heated about a 30-year mortgage or a 15-year mortgage, and people like Dave Ramsey only say to get 15-year mortgages or basically just don't even buy a house. And this is not financial advice, so whichever decision you make is on you, but I am going to break down the numbers and let you know what I think about going with a 30-year or a 15-year mortgage. But remember, this is for entertainment purposes only. So what are the advantages of getting a 15-year mortgage versus a 30-year mortgage? Well, for starters, when you get a 15-year mortgage, you're gonna get a lower interest rate. And this is especially a big deal when you see interest rates climbing like they are right now. And a lot of people are out there trying to get the lowest rate possible. And so getting a 15-year mortgage is a great way to get that lower rate. Another great benefit to the 15-year mortgage is pretty obvious. You're gonna pay off the home much faster. In fact, in half the time. Wow, who knew? And because you'll be paying off your home at double the rate of a 30-year mortgage, you're gonna have much more equity that you're building up much quicker than with a 30-year mortgage. And as a result of you having a lower interest rate with a 15-year mortgage and you're paying off the mortgage so much faster, you're gonna be paying significantly less in interest over the life of the loan. And I'll be breaking down the numbers here in just a bit. But despite all of those positives, there's also some negatives when you go with a 15-year mortgage. For one, your payments are gonna be much higher than if you just go with a 30-year mortgage, which makes sense because you're paying off the home in half the time. And the next problem, and this will really apply if you're looking at investment properties, you're gonna have much less cash flow from that property because your payment is going to be so much higher. And another result of that higher payment is you're going to be able to afford much less home than with a 30-year mortgage. Typically with a 15-year versus a 30-year mortgage, you're going to be able to afford about 20 to 25% less home than if you go with a 30-year mortgage. So that's the 15-year, but what about the 30-year mortgage? Why does most everyone choose that option? Well, pretty much for the opposite reasons that people choose the 15-year mortgage. Some of the best benefits of the 30-year mortgage is since you're stretching out those payments over a longer time horizon, you're gonna have a much lower monthly payment, which a lot of people prioritize. And because of this lower monthly payment, people can often have money left over in their budget that they can use for other things, other toys, other fun things, or other investments, which we're also gonna get to. And one of the biggest benefits of a 30-year mortgage is people are gonna qualify for a much nicer house than they are with a 15-year mortgage. Because their payment is gonna be lower, they're gonna qualify for a higher purchase price. But the downsides of the 30-year mortgage is obviously that the interest rates are going to be higher than the 15-year mortgage. You're going to take a lot longer to build up equity in the home. You're going to be paying a lot more interest, and it's going to take you twice the time to pay off the entire loan. But the problem I typically see is that most people are just comparing the 15-year versus the 30-year mortgage, and they're just looking at that delta, that change in interest payments over the life of the loan. They're looking at how much they can save by going 15-year versus 30-year, which makes sense. Obviously, you don't want to be paying a ton of money to the bank. At least I know I don't. So people obviously want to spend the least amount of money on interest as possible. I totally get that. But hopefully as we get into these numbers, you can see why paying more interest up front might actually be making you more money in the long term. So here's the real thing that you need to consider when you're making your choice. You need to consider the opportunity cost of that additional money that you're going to be putting towards that 15-year mortgage versus the money that you would save by going with a 30-year mortgage. And so with this breakdown that I'm about to show you, I'm going to show you what happens if instead of going with a 15-year mortgage and having that higher payment, you instead took that extra money that you're saving with the 30-year mortgage and put that money into investments. And I'm just going to be looking at the averages here. So if your numbers in your state or your city are a bit different, well, run those numbers yourself, but this is just the average for the nation. So the median home price in 2022 across America is a whopping $408,000, and I know that's a lot of money to most people. And calculating your purchase at a 5% down payment, which is gonna be about $20,000, that leaves you with a $388,000 loan that you're looking to get from a bank or a lender. And the current interest rates for a 15% mortgage is 3.44%, but a 30-year mortgage these days is gonna run you about 4.2%. And so here already you're gonna see really quickly why people start making the case for a 15-year mortgage. Just look at how much interest you're saving already just in your rate. So if you finance this $408,000 home and you get a $388,000 loan on a 30-year mortgage, your monthly payment is gonna be $1,897 per month versus if you go with a 15-year mortgage, your payment is gonna be $2,762 a month, which leaves you with a difference of $865 a month that you're spending extra by going a 15-year mortgage or that you're saving if you go with a 30-year mortgage. Now here are the numbers that everyone just loves to look at and talk about. If you go and get a 15-year mortgage at that purchase price and at that rate that I just specified, and keep in mind that those payments do not include your taxes and your insurance or any of those things. It's just your principal and your interest. But with that 15-year mortgage over the life of the loan, assuming you pay it off in its entirety, you're going to be paying $109,219 just in interest, which I know that can seem like a lot, but when you get that 30-year mortgage, you're going to be spending $295,059 over the life of the loan. That means that if you get a 30-year mortgage, you're going to be spending $185,840 more than if you would have just gotten that 15-year mortgage. And this is where everyone just really goes nuts about this whole conversation, because when you look at those numbers, obviously you're going to save way more money if you just go with the 15-year mortgage. But now let's look at what happens when someone takes the 30-year mortgage over the 15-year mortgage and then invests the payment difference of $865 at an 8% return. And I'm using an 8% return because that's typically what the S&P 500 does over a 10-year span. So if you got that 30-year mortgage with a lower payment and you took that $865 and invested it every single month at 8%, your total contributions to your investments would be $311,400, and after 30 years, your portfolio would be worth $1.297 million. So that's pretty awesome, right? You invested $300,000. At the end of 30 years, you have $1.3 million, so you made $1 million off of your investments. Who doesn't want that? But that's just one side of the story, because what happens if you get the 15-year mortgage and you make those payments, you don't invest during that time you have the mortgage, but what if after the home is paid off, you keep making those same payments, but in investments that yield 8%? Well, if you decide to do that, in this case, you're gonna be investing $2,762 every single month, which is awesome. And it really won't make a difference to your budget because you were spending that money on your mortgage anyway. So after 15 years of doing this and investing that money every single month, your total contributions will be about $497,000. Your portfolio will have grown to $962,129. That means that your investment portfolio has grown by over $335,000 by going with the 30-year mortgage versus the 15-year mortgage. But wait, before all of you keyboard warriors go crazy, that's not the whole story, because you paid more in interest during that 30-year mortgage. So when you take that gain of $335,000 that you made by going with the 30-year mortgage and investing the payment difference, and then subtracting the extra money that you paid in interest, that $185,000, you still have $149,786 more by going with the 30-year mortgage and investing the payment difference than by going with the 15-year mortgage. And that's exactly why I say getting a 15-year mortgage is costing you money. In fact, it's costing you about $150,000 in this scenario. So if you can fit yourself into that equation that I just outlined, then going with a 30-year mortgage is going to be more beneficial for you in the long run. But there's obviously a huge problem with this entire method that I've just spelled out, and the problem is that most people don't do this. Most people aren't looking at 15-year versus 30-year mortgages and saying, well, if I just get the 30-year mortgage with a lower payment, I can just invest the difference and make more money. People aren't doing that. And the reason is because it takes a lot of discipline to dollar cost average every single month into the market, regardless of what's happening with the rest of your budget and the rest of your life. One of the main benefits of having a mortgage, whether it's 15-year or 30-year, is it's really forcing you to pay money every single month into an appreciating asset. And having a 30-year mortgage really gives you more flexibility with your budget, because you can take that extra money and you can invest it if you so choose. But if you're one of those people that's gonna get the 30-year mortgage and you're just gonna go blow the other money on toys and on food and on whatever else, then you're honestly probably just better off going with a 15-year mortgage and paying off the house a lot quicker. But if you do decide to go with a 30-year mortgage and then just automate your investments every single month, so just like you have your mortgage on autopay every single month, you also have your investments on autopay every single month. And that will take a lot of emotion out of the investing decision, because you'll already have spent that money without even thinking about it. So in summary, if you can get a 30-year mortgage and invest the difference, you're gonna be better off in the long run. But if you know you don't have that kind of discipline and you don't wanna make other investments for some reason, then just go with a 15-year mortgage and you're gonna spend a lot less in interest. So let me know your thoughts down below. I know I didn't cover every single aspect of this conversation, because we could still talk a lot more about how often people move and how people typically don't even pay off their mortgages. And we could also talk about how your home appreciation is gonna factor into this equation, but that's a topic for another video. Thanks for watching, and I'll see you in the next one.